And welcome back, ladies and gentlemen. This is Insight on Business, powered by our advertising agency, Insight Advertising, Marketing, and Communications. We get to hang out live with you at 8:45 each and every Monday here at Webcast One Live, brought to us by our friends at Fuerza. Fuerza, tax and accounting professionals that will work hard for you until the cows come home. What are your favorite brands out there? Could they be on the chopping block? Is your favorite brand going to get the axe? Well, there's been a lot of discussion about this over the past week. Wall Street 24/7, as they do each and every year, listed out the 10 brands that they say are not going to make it. And here's what they looked at. Here's the criteria that they looked at with regard to these brands: declining sales and revenue losses, disclosures by the parent of the brand that it might go out of business. I guess if you disclose that you might go out of business, that's probably a pretty good reason to tank the brand. Rising costs that are unlikely to be recouped through higher prices, and companies that will be sold. They also talked about companies that go into bankruptcy, companies that have lost a great market share, and this is very important, a great market share of their customers by failing to upgrade their product and or service. And those operations, of course, with a withering market share because of obvious issues. Well, each brand on the list suffers from one or more of these problems, and each of the 10, according to 24/7 Wall Street and Bloomberg News, will be gone in 18 months. Now, have they missed their predictions? Yes, they have from time to time, but we'll go ahead, show you the logo of each one of these and give you the background information that they said could mean a tank of the brand. First up, these guys. We talk about them every once in a while. This is J.C. Penney, ladies and gentlemen. Now, J.C. Penney, we've shared with you about their dismal track record experienced by this iconic brand. Spending more in advertising, but seeing sales slump by over 25% last year alone. While the most recent quarter was considered an improvement with sales down just 16.4%, in reality it was nothing more than a brief reprieve, says Wall Street 24/7. There's absolutely no reason to believe that J.C. Penney's prospects will improve in the near future. You've heard of Nook? Well, this is number 9 on our list. Sales at the company's Nook segment, which includes their e-reader and online books, declined by 26% between the third quarter of 2012 and the first quarter of are expected to decline between the third quarter of 2012 and the third quarter of 2013. The Nook's disadvantage might have little to do with its hardware or software and more to do with the size of its online audience. Get this, it competes with much larger e-commerce sites that have access to hundreds of millions of new readers. While Amazon has more than 130 million visitors a month, according to Quantcast, Barnes & Noble has just over 6 million visitors. Just not enough people. Next, Martha Stewart. Martha Stewart Living Magazine, we should say. In the 5 years up to the end of 2012, publishing revenue fell from $179.1 million to $122 million. Last year, the division lost $62 million, the magazine did. In the first quarter of this year, publishing revenue dropped from $30.8 million to $24.5 million. The unit lost $990,000 in that period. Because of its troubles, get this, the company tried to sell off smaller magazines. Its Everyday Food stopped publication as a standalone title with the December 2012 issue. Whole Living was discontinued after the January-February 2013 issue. So Martha Stewart Living Magazine looks like it's on the chopping block. They say it won't be around come 2014. LivingSocial. Remember when LivingSocial was all the rage? I mean, everybody had to have great fun living social. Well, Adweek recently reported that sources could not be surprised if the company was sold to a larger company or liquidated piece by spring 2014. That's a long way from when Amazon.com confidently, remember this, invested $175 million in LivingSocial back in 2010. The deal soured as the huge e-commerce company wrote down the investment by $169 million in late 2012. More recently, an Amazon SEC filing indicated that LivingSocial lost $50 million in the first quarter of this year, compared to a profit of $156 million in the same period a year ago. LivingSocial may very well get the axe, according to Bloomberg News and Wall Street 24/7. These guys, we're going to hear from Josh Dreyer in just a little bit. This is Volvo. This is what they say about Volvo. In the United States, Volvo was never a giant manufacturer with a large number of models or ultra high-end brands. As of April, its market share in America dropped by 0.3%. Volvo's future is in question, not just in the U.S. The company's dealerships in China inflated sales numbers to receive cash incentives from the company that never went to customers. That's according to Brand Channel. In other words, some of Volvo's dealers committed fraud. Yikes. Cameras. Another brand that could bite the dust by 2014 is Olympus. Olympus. Worldwide unit sales are down 18% in 2012 since the peak in 2010 and are accelerating this year. It's no surprise then that Olympus, which has only a 7% market share, has failed to generate profit from its imaging business in any of the past 3 years. The decline caught the company's management off guard. Actual sales were less than 2/3 of forecasts. Of concerns to investors, the company has pledged to stop issuing dividends until the camera business restored to profitability. If you're holding on to those shares, that's something you don't want to hear. How about basketball? Let's go to the WNBA. Get this, the league was founded in 1996 and it currently has 12 teams. 24/7 Wall Street, Bloomberg News say these folks are not going to survive till 2014. 6 teams have disappeared since the league's beginning and 3 have been relocated. Attendance, by the way, has been just plain awful. Average regular season attendance by team per game was only 7,457 in 2012, compared to about 18,000 for the NBA. The WNBA attendance number was below 6,000 in Atlanta, Chicago, and Tulsa. Even in New York City, get this, the New York Liberty could not break the 7,000 fan attendance barrier. The Chicago Sun-Times reported in 2011, quote, the majority of WNBA teams are believed to have lost money each year, with the NBA subsidizing more of the losses. TV viewership is so low that it only makes matters worse. Could the WNBA get the axe? Could be. Leap Wireless. Leap is just plain too small to survive. The best proof is in its subscriber counts and earnings. Wall Street lost confidence in Leap a long time ago. Its shares are down 90% over the past 5 years, while the NASDAQ is up by 40%. Leap's management is probably known it needs a partner for a long, long time. In October 2012, Bloomberg Businessweek reported, quote, after reporting net losses for the last 6 years, analysts and forecasting, Leap will remain unprofitable through 2015, according to data and estimates. And the risk factors disclosed in Leap's annual report, according to news reports, look like a roadmap to Chapter 11. Like these cars, these are Mitsubishi. In the first 4 months of the year, sales have fallen by 6.5% to just 20,571 vehicles. The U.S. Market share of Mitsubishi was only 0.3% in April. Mitsubishi does not have the advantage of some other companies with low market shares. It's not a luxury car company like Porsche or Land Rover, which sell high-end cars and command high prices. The average price for Mitsubishi's 7 models is under $25,000. And finally, one of the brands that may hit the dust is Road and Track? Seriously? The Hearst-owned magazine is in trouble, even if it is the oldest title in the car business. The 4 dominant magazines have all posted advertising sales drops in the past 5 years, as Car and Driver, Motor Trend, and Automobile have each lost hundreds of ad pages. Road and Track has had the worst of it. Ad pages fell from 1,092 in 2008 to 699 in 2012. Pages are down another 31% to 232 for the first 6 months of this year, according to... this is not looking good. No large national magazine can continue that kind of a long term slide. Road and Track subscribers could also be migrated over to Car and Driver, its sister publication. The 10 brands, ladies and gentlemen, that many of the experts believe are not going to make it until 2012. When we come back, we're going to have Josh Dreyer is in the studio, and he's going to say, well, wait a minute, Michael, hold on just a second. That whole story about Volvo, not true. He posted something online about it last week, and we'll talk to him about his findings. Josh Dreyer from Willis Auto Center is coming up next, right here at Insight on Business. We'll be back right after this.